Mahesh Nandurkar joins us, and it's that time of the year where we talk about and reflect back on the year gone by and talk about what trends we should expect for 2024. Frankly, in our book at ETNR, we feel that this is a year of beating the odds. Yes, at the beginning of the year, nobody anticipated such a stellar rally in benchmark indices. The fact that Fed would talk about interest rate cut, the fact that we will see back of inflation, and we will see such a stellar rally in just about every asset class, from gold to Bitcoin to small cap to mid cap stocks. So what has really surprised everybody? If I look at the year-end targets for 2023 at beginning of January, Goldman Sachs 20,000, Jefferies 18 to 19,000, BofAML 19,000, Kotak Securities 18,000. So everybody is pleasantly surprised with what we thought in January 2023 versus where we are in December 2023. Mahesh, that's the tone. That this year the odds in a sense have managed to defy a law of gravity. What to your mind has been the surprise factor? Why are we in for such a grand year? And what has changed in terms of assumptions from January and now?
I think the big thing which has been a big positive surprise for this year CY23 is that the way the market has reacted to the rate hikes. At the beginning of the calendar year, it was already quite well known that the Fed would be raising rates, and they did. And we've actually seen one of the steepest rate hike cycle in the history of the US markets. But yet, I think the market did very well, because I think while the rates kept kind of moving up, the QE, which was initiated by Fed, immediately after the COVID, implied that there was a lot of liquidity still sloshing around in the system. And while the rates kept going up, the liquidity still propped up the global markets and all the asset classes that you're talking about. So that's been a big positive surprise. And now we are come to the end, and therefore we are looking at the latest Fed commentary on the rate cuts. So my sense is that rate cuts is definitely going to be a sentimental positive, but just like the way we saw a positive surprise coming in from a very strong market reaction despite the rate hikes in CY23, the rate cuts of CY24 need not necessarily be interpreted in the positive way like we used to interpret earlier. But I think what still remains is the fact that there is ample liquidity in the global markets. And what is positive for India and generally for the emerging markets is that most likely this year will mark the peak of US dollar. The emerging market currencies such as India will be doing much better this year. And that is an ideal environment for foreign flows to come into emerging markets and in India. So while we've had a stellar CY23, I think CY24 should continue with that strength, and we should be expecting strong double-digit returns for the Indian markets in CY24, unless something goes wrong terribly globally.
CY24, which is we are talking about January 2024 to December 2024, you expect benchmark indices will give double-digit returns, but you're also accounting for the election volatility in that, I'm assuming.
Yeah, for sure. Election volatility will play around somewhere around like April, May. But I mean, obviously, we've seen some of the opinion polls, we've seen the consensus expectations, and it looks like the market is bracing up for political stability. Some of the recent state elections also were in the similar direction. So, so as I said, unless something, goes wrong terribly globally or politically, I think the markets would be in for a good stead.
When you say markets would be in a good state, are you cognizant of the valuations? Because we are now just a shade in and around our 5-year average.
Absolutely. Absolutely. I think the valuations, is something that has, kept a lot of foreign investors still at bay. While CY23 was a reasonably good year for foreign flows, but that was very, I would say, not a very broad-based flows that we've seen. In fact, my interactions with most foreign investors still suggest that several of the emerging market investors are only marginally overweight on India, much lower than what they used to historically. And the primary reason has been valuation and the political uncertainties that you alluded to. So my sense is that CY24 will see strong foreign inflows. And many of the global mandates, I'm not talking about the emerging market mandates, because emerging market investors have India as a part of their benchmark, about 16-17%. So they are following Indian developments pretty closely. But I'm quite optimistic about the global mandates, where India's neutral weighting is very low, just about 1 to 2 percentage points. And those kind of funds haven't really taken big positions on India as yet, barring a few. And I'm expecting more flows coming in from that side. And as I mentioned earlier, the weakening of the US dollar and a strong performance of the emerging market currencies and Indian currencies expected for CY24 will be a big draw in my view.
What are your earning estimates for next year?
So FY25, we are looking at earnings growth, in the range of around 15%. FY26 would be slightly slower, but yeah, I mean, FY25, we are still expecting reasonably strong 15% earnings growth. So, even, if we build in a small derating of the markets, on an overall basis, the index should return close to, say, 12-13% or so.
Mahesh, the other thing I wanted to understand is, there is, of course, a big event, right? You'll have the elections as well pretty soon. Could that be a market-moving event, or do you think the market pretty much has priced it all in post the state election verdict?
I think most of the investors, I would say domestic investors and many of the international investors who track India closely, I would say have factored the possible outcome already. But as I mentioned earlier, I still have that sense that a lot of large global mandates are still sitting on the sidelines. And I think post-elections, assuming that there's a continuity and stability, on the political side, we will probably see more foreign flows.
That brings me to, what PSUs have done. The untouchables of the past decade, or, many more as well, have really been the shining stars all through 2023, right? But again, the rhetoric on whether or not there is continuity of the government and the policies, etc., a lot would depend on the continuity of the PSU rally that one is currently seeing. And I'm talking ex-banks right now.
Yeah, true. So many of the state-owned companies appear reasonably attractive on valuations, despite the recent rally that we have seen, especially on the mining side, the power utility side, and there are a few other subsegments which look reasonably interesting. One could argue that possibly some of the other PSU names, on the defense side and some of the other segments are not that cheap anymore. But yes, one segment of the state-owned companies still appears, quite reasonably attractively priced at this point in time.
Mahesh, what to your mind is going to be the way forward for global denominated sectors? Because that's the tricky one to call. China will decide metals, US will decide IT.
That's right. So my sense is that we are still looking at an environment where global growth and the US GDP growth is going to be slowing down in CY24 as compared to CY23. And there could be some revival beyond that in CY25. But at least the next 12 months, appear to be a weaker growth, year. So that's the reason why we continue to stay underweight on IT services. And maybe once we begin to get towards the tail end of the next calendar year, and maybe the market would have factored in, by that time, the demand weakness, etc., it would be a good time to start considering at that point in time. But for now, we are underweight on IT.
Mahesh, hi, morning. Just going by the report, given that the outlook is that the consumption trends have been broadly resilient, what exactly does this spell out for the sector going ahead, noting that the inflationary concerns do continue to remain an underlying concern for the space?
I think consumption can be broadly categorized into three parts. I would say the top end, the middle end, and the bottom end. I think the top end of the consumption is doing extremely well. The middle end, we have seen some selective, sectors, subsectors, where we've seen slowdown, which is like consumer durables have seen slowdown, like the air conditioning, the refrigerators, and even some of the kitchen appliances, etc., have seen slowdown. But still, looking okay. But it's really the bottom of the pyramid, which still continues to struggle, in my view. And it has taken surprisingly long for that segment of the consumption basket to recover. My sense is that, say over the next 1 to 2 quarters, things should begin to improve. But that still continues to be, a drag. But having said that, I would still say that many of the consumer stocks are still trading at expensive multiples. So I would say that I'm much more favorable for capex-oriented sectors, be it like banks, industrials, real estate, power, telecom, etc. So we would be overweight on those sectors, and we would still be underweighting consumption sectors, barring autos.
Mahesh, so which end of the market to your mind right now is mispricing growth on the upper side and on the lower side, where there could be derating because assumptions are very high and we could be in for a disappointment, and where do you think assumptions are low and we could be in for a surprise?
I think, in terms of the earnings growth at a very broader level, the market expectation, as I mentioned, about 15% earnings growth seems to be realistic to me. But yes, there could be, some like disappointments here and there. I mean, like for example, I do expect that in the upcoming, budget, given the fiscal consolidation targets that we are looking at, there will probably be some slowdown in the government capex growth that we will probably see in for FY25 and for FY26, and that could create some near-term pullbacks. But I don't think the slowdown, the possible slowdown in the government capital expenditure growth, will be a negative for capex cycle from the long run perspective, because the housing cycle and the corporate capex cycle is trending up very nicely. So there could be some of those, near-term, pullbacks that might, get created. But I think those pullbacks will get bought into, according to me.
When you say that you expect that post the election mandate, more flows will come, don't you think there is too much of reliance on flows? I mean, from last 3 months, we've been using the phrase that FIs will come back. The Hindi colloquial would be, यहाँ नहीं अब नहीं तो कब कहाँ जाएंगे FIs. There's just too much of attention centered around the fact that flows will come back, and they are the ones, and FIs will come back and they will drive the markets higher.
No, I think that's still a reasonable expectation, because as I mentioned, our analysis shows that the emerging market funds have a very small overweight on India at this point in time, and many of the large global mandates are not really present. And now, given the size and the scale of the economy and of the markets, I can definitely see from my personal interactions as well that Indian markets is definitely showing up on the radar screens of a lot of large, global funds who haven't yet participated in the, in the markets as such. And also, many of these funds that have been historically invested in, China for a long period of time. And we know the geopolitical changes that have been happening. So all those are the factors that are supporting this expectation about the foreign inflows improving going into CY24.
And do you expect the domestic flows to continue? Because to be very frank, Mahesh, I mean, we've discussed last 5 minutes on global flows, but the importance of domestic flows cannot be ruled out. We're looking at a number of about 1,30,000 to 1,40,000 crore only coming via the SIP route.
Absolutely, absolutely. No, I think domestic flows has been a very, very strong backbone for the Indian markets over the last, 5 years or so, or maybe even longer, actually. And actually, this is a trend that we've seen in many of the regional markets. We've seen the other markets like Australia, Korea, Taiwan, etc., over the last 25 years or so, have switched completely away from foreign-dominated markets to local or the domestic-dominated markets. And I think India is making a move. The Indian markets are making a move in the same direction that Korea and Taiwan and Australia have seen, over the last, couple of decades. So it's not something that, that hasn't happened elsewhere in the world. I think India is kind of following, the suit. And I still believe that there is, ample opportunity for the domestic flows to, kind of continue, because the Indian households at a gross level save about 750 to $800 billion annually. And the kind of numbers that you talked about is still less than 5% of the annual savings of the households. So I don't think that there is any structural issue with the with the domestic flows, or the flows have gone to a level from where they have to come down. I don't really think so.
Give us a sense as to what the outlook is as well when it comes to the liquidity situation in light of the big event as well that is lined up. The fact that we have seen quite a comeback from the FIIs, what do you believe that the next year will hold in store?
So as I mentioned, I'm expecting 12 to 15% return from the broader indices, and there will obviously be some sectors that will do much better. And I think the sectors that will be doing much better are the investment-oriented sectors. So as I mentioned, I still like the industrial segment, the capital goods, the real estate, power, banks, of course, because many of the large banks have been laggards in the last 12 months. And that's the only sector which is actually looking quite attractive on the valuation front. So those as well. And of course, as we discussed, many of the state-owned companies in the power, utilities, mining space also appear to be quite attractive. Whereas I believe that some of the sectors that will probably underperform are the consumer staples, consumer discretionary outside of the autos, the energy sector, the IT services. I think those will be some of the underperformers in my view.
Government theme, according to you, railways, defense, power. A lot of attention has been centered around railways, defense, and power.
Yeah, I think power is looking like a very, very strong story to me. I think, if you look at the capacity utilization of the thermal power sector in India, we will be crossing 80% utilization level next year. Now, that kind of utilization level is something that we have never ever seen in the last 25 years. And my sense is that given the strong demand environment that we're getting into, given the fact that we believe that the next leg of the GDP growth is going to be investments driven, which will be more power hungry. So this 80% plus utilization levels can sustain for the next few years. So from that perspective, it looks like a very strong theme to be following, even from the next 3 to 5 year perspective. As I mentioned, a couple of other themes, railways and defense will just need to kind of, weigh in terms of the valuation versus the near-term outlook. Because as I mentioned, the fiscal pressures will probably mean that the government will need to tone down the capex growth going into FY25. So we'll need to see, how those subsectors get impacted. But by and large, broadly speaking, there are several state-owned companies that are looking very attractive at this point in time.
It's interesting that you say power, because it's almost been a frenzied sector, right? If you especially look at the financiers. I mean, the recent listing of IREDA, what PFCREC have done in the past year gone by. Mahesh, you think it's time to not take concentrated bets now on power and look at the infrastructure per se, stocks that haven't moved, the ancillaries that will come to the fore perhaps in the year to come?
No, I would basically say that the overall, chain, I mean, starting with financiers and the power generators and the transmission companies and the ancillaries, that you mentioned, the whole chain stands to benefit. And while, as you rightly mentioned, the stocks have gone up quite a lot, several of the stocks gone up quite a lot. But if you ignore the stock price movement over the last 6 months or the last 1 year, which actually looks quite astronomical, but rather, if you just focus on the absolute valuations, whether you look at the comparison for the financiers between the return on equity versus the price to book, it doesn't look, that stretched. So yeah, there can be some pullbacks, but even if you take a 1 year, 2 year, 3 year view, several of these names will actually give much higher than the market returns.
Okay. Mahesh, what is the what-if risk for 2024? Is it Fed? Is it election? Is it China?
I think the risks, according to me, are twofold. One is obviously the unforeseen global risk, and that is something that we need to keep in mind. In fact, one of the things that I would highlight, and we have been highlighting this, from the global standpoint as well, that the private equity space, globally, can see, some can see some pressures, because that's been one segment where there has been leverage investments, and if something were to kind of go on the unexpected lines, then that can actually create some kind of a risk of in the equity markets. And of course, I mean, there could be some other unforeseen global events, which we always know kind of keep on happening once every few years. And the fact that the global markets have done very well, generally speaking, over the last say in the post-COVID world, so over the last 3.5, 4 years. So one cannot rule out the possibility of some global event. But I would say that's really the key risk to kind of keep in mind, but something that we cannot really track or cannot really keep our hands on at this point in time. And secondly, as I said, given where the Indian valuations are, there is a very, very strong expectations of corporate performance and earnings growth. And if there were to be some disappointment, I think that would be the other sort of factor to keep in mind, the burden of expectations, given where the valuations are.
And curious to get your take, Mahesh, as to what's been happening within the primary markets. It has been a very hectic year when it comes to a lot of listings as well that we've seen. Is there any opinion or views on the kind of valuations that they've commanded, how the businesses have shaped up?
So I'm actually quite optimistic about a lot of these new listings and the new IPOs, because what is really happening in the Indian markets is that after a long period of time, we are seeing newer stocks, newer sectors are entering the stock markets, and it actually is a broader reflection of what's happening in the economy. There is clearly incremental risk appetite in the broader economy. I'm not talking about the markets here. I'm talking about there is a improvement in the risk appetite in the broader economy. So the more new businesses and more new sectors are emerging, and what we are seeing in the stock market is just a reflection of what's happening in the real economy. So over the last 10 years, the mantra was that just stick to the quality, just avoid making mistakes, and your investment portfolio will do well. But that has changed in the last 1 or 2 years, and I think that change is a very positive one. And I think the investors do need to adapt to the new reality, that that we are in an investment upcycle and broad basing of the market. In fact, Nikunj mentioned that the fact about the market breadth. I think the market breadth will continue to be the big factor over the next several years. And from that perspective, a lot of these new listings and the emergence of new sectors bodes well for that.
Okay, Mahesh, great to have you on the show, and we'll see you now in 2024. Wishing you a healthy and prosperous year ahead.
Thank you very much, and wish you and your viewers the same.
Thank you so much.